Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 198 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to continue our conversation on index funds. We talked about Jack Bogle and the creation of index funds on Monday. Yesterday, we went ahead and talked about the three major indexes, the Dow, the S&P, and the NASDAQ. And now we are going to focus in on the dark side of index funds. Now, I really enjoy using index funds. I like index funds, but just as with anything else, there are negatives, and we want to understand what those are to be more informed investors. So stick around for that, and hopefully it can help you to make better investing decisions as you move forward. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out on these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So my goal today is absolutely not to scare you away from index funds. That is not the point. All right, I'm spending a week on index funds because I think they are so important and they are so vital to just about everyone's long-term investing future. And so I don't want to scare you away from index funds, but I want you to be fully informed. And so that's why I do want to spend some time on things that are negative, the dark side of index funds. And let me go ahead and preface doing so by saying that none of these things are so bad that it should keep you from investing in index funds, but they are all considerations that you must make in order to better understand what you're investing in and make the best investment decisions for yourself. But before we jump into the disadvantages, the bad parts of index funds, let's talk and review a bit about what the good things, the good parts of index funds are, why we like index funds. That way we can hear everything else that we talk about in today's episode in light of these few positive attributes that really drive my reasoning for wanting to use index funds as a large part of my investment portfolio. Okay, so one of the main reasons why using index funds is so attractive is because it's easy. It is extremely easy to use index funds, right? It doesn't require a lot of work from you. It is very passive in nature. You can invest in something and know that you can make market rates of returns over the long term and not be worried about picking stocks for yourself or picking bonds for yourself or determining if you're going to make money or lose money here, or if you're going to outperform the market or underperform the market. You are going to have the market returns right there in front of you, and so you don't have to worry about trying to outperform and pick individual companies or individual securities for yourself to be invested in. So it makes life really, really simple. It is a way that you can simply invest and not pay attention to anything except for your asset allocation, except for your diversification mix, how you mix different types of index funds into your portfolio. Okay, so we like how simple it is. We also like the lack of cost. It is not very costly to invest in index funds. Index funds are very, very cheap to invest in. And especially cheap relative to actively managed mutual funds that you could invest in, because those are going to charge much higher expense ratios and could come with some loads on top of those expense ratios, whereas the index fund is typically going to have a small expense ratio and no load associated with it, which is very, very attractive as well. Further, investing in index funds feels a lot less like gambling than just about any other type of investing, because you know what you are getting. What you are investing in is already set. You don't have to trust some stranger to invest you in whatever they think is best, some portfolio manager, some person behind door number one, right, in order to invest you in whatever they think is best. Your investments are set based on whatever index that fund is trying to replicate over time. Okay, so we know it's simple, very low cost, right? It doesn't leave a lot up to interpretation when it comes to what you are going to be invested in. And you know that over the long term, you are going to make adequate rates of return. You are going to make rates of return that are going to be able to make you wealthy over the long term, because the entire equity market is going to play pretty close to the S&P 500 or the NASDAQ or the Dow or whatever, right? So the entire stock market, if you take a diversified portfolio of stocks, it's going to play pretty close to those particular averages. Now, you could pick a group of stocks on your own that outperforms really well over a long period of time. It is difficult to do, but you can absolutely do so, which is why I'm okay with you investing in individual stocks some, right? But I do say that the vast majority of what you should invest in is index funds for the simple reason that we can have these funds around for a long period of time, and you know what return you are going to receive approximately relative to the rest of the market, and you don't have to vie for 2% here or 2% there. Even though 2% can make a huge difference, we have seen that active managers and hedge funds and other things cannot sustain the spreads that they make on the indexes over the long term, especially given the costs. And then one last reason that we want to invest in index funds is because they are widely available. You can purchase them just about anywhere, and you know what you are going to get. You don't have to wonder. You don't have to ask any questions. You know what that particular index fund is going to be tracking. Now, enough with all the nice stuff, right? We have talked about the good parts, the things that we like about index funds. But what about the things that we don't like so much? That's what I want to spend the remainder of our time today on, is what don't we like as much? Because index funds seem very simple, they seem very harmless, and in most ways they are. That's why they're so attractive to many. But what really turns us off about index funds? Well, the first thing that I want to talk about that can turn you off about index funds is the calculation of the index itself. We talked yesterday about the ways in which the different indexes are calculated, right? The way that the number that you see, if it's the Dow, the 34,000 that you see, or if it's the S&P, the 4,100, or whatever it may be, right? How does that come about? Well, we talked about market capitalization weighted indexes like the S&P and the NASDAQ, and we talked about price weighted indexes like the Dow Jones. And these different index types, the ways in which they are created, are going to give you different types of exposures. Okay, I gave the example yesterday of Apple and how Apple in a market cap weighted index is going to be your highest weight. It's going to be what more of your money is invested in than any other company, because it's the largest company in the world. So it is going to be the largest portion of your portfolio in a market cap weighted portfolio. But in a price-weighted portfolio, like if you invested in a Dow Jones index, right? In a price-weighted portfolio, Apple's stock price is only 130 something, right? Apple's stock price is not extremely high relative to companies like Amazon or companies like Tesla or companies like Chipotle, right? Who all have much higher stock prices than Apple, right? But Apple still is the largest company in the world by market capitalization, yet in a different type of index, it is going to be weighted differently, right? So something that we don't like with these indexes is the fact that you're going to have companies of different weights, and it's actually quite arbitrary, especially with the price-weighted indexes, because stock price doesn't mean much at all. But even with the market capitalization index weightings, right, you still see that the largest companies get the most weighting. Well, where do you think you're going to get really, really good returns? From companies that are 2 trillion or companies that are 50 billion? Well, probably you're going to get higher returns out of companies that are 50 billion in size than you will out of companies that are 2 trillion in size, because they have more room to run. They have more ability to grow than a $2 trillion company. Not saying a $2 trillion company can't do well. I'm just saying that a smaller company, more risk, more reward. Okay? And so this is a disadvantage of index funds, because as the stock prices of some of those larger constituents increase, especially in market capitalization weighted indexes, then you are going to see those companies really increase in the value of your portfolio. And then some of those smaller companies, if they don't move up the ranks as far as market cap in a significant way, then the way they impact the portfolio is still very, very small. So your portfolio can be driven by a select group of companies. So even an S&P 500 index, your top 20 or 25 holdings are going to provide most of the return for the index. And so you're going to miss out on some of the things that smaller sized companies or smaller priced companies, lesser priced companies, can do for your portfolio, given the different types of indexes. And we know as well that if you invest in an index fund such as the S&P 500 or the Dow Jones, that you're only getting large companies. You're not getting any exposure to companies of smaller size, and you're not taking on any additional risk that could provide more return with a more broadly diversified portfolio or with a portfolio that has smaller stocks in it. That's why a lot of times holding one index fund is not the most preferential treatment to your investments. You might want to hold multiple index funds that track different sizes of companies or different types of companies. So you can get small, medium, and large cap, or you can do international stocks versus domestic, different types of things that can diversify your portfolio and give you returns in different places. Okay, so that is something that is not advantageous to us as index fund investors. What's another downside of index funds? Well, they can be beaten. Okay, I wouldn't tell you to go about purchasing individual stocks at all if I didn't think that index funds could be beaten in some way, shape, or form. Okay, is it easy? No. Does it take a certain temperament? Yes. Right? Is it something that everybody should be doing? Absolutely not. But they can be beaten. I talked yesterday about how actively managed mutual funds only outperform the indexes over like a 15-year period in 10% of cases. But that still means that 10% of the mutual funds out there are going to earn more than the index funds. Now, do I want you to go out and try to pick based on past performance and look all willy-nilly about what particular funds may outperform the index or not? Absolutely not. But there are some fund managers that are just better. There are some fund managers that are better than others, and there are some things that some fund managers do that you will not be able to take advantage of if you are invested in index funds. Not only that, there are strategies that you may want to implement with your investing that you can do yourself, right? This is the whole Peter Lynch method. Peter Lynch talked all the time about how you could do it. His investing methodology was very, very simple. You could do what he did. Okay, but you can't do what he did if all your money's in index funds. Okay, and he provided some of the best returns that the market's ever seen from a mutual fund manager. So you can provide yourself with higher returns than index funds. It is not extremely likely, and it is very difficult, right? But it can hold you back. An index fund can hold you back from successful ways of investing, from successful ways that you can allocate your investments, whereas an index fund is just very, very fixed. So what else do we not like about index funds? Well, index funds actually have a lack of downside protection. There's a lack of hedging that goes on with index funds because you're only invested in one type of asset that's going to track one market, and your money is going to do what that market does. The stock market has proven to be a great investment in the long run, but over certain years, it's had its fair share of bumps and bruises. Okay, investing in an index fund such as the S&P 500 index fund will give you the upside when the market is doing well, but it also leaves you completely vulnerable to the downside. And I think this is really, really interesting because I just listened to the Berkshire Hathaway annual meeting this past weekend with Warren Buffett and Charlie Munger. And Warren made the statement that Berkshire Hathaway will do better than the market on down years. Now, why? It's because of the way that they're allocated and the way that they invest the money that they make, right? And by the way, if you don't listen to the Berkshire Hathaway annual meeting, whether or not you're a shareholder, that's an absolutely great place to learn more about investing and learn from two of the greatest ones out there, Warren Buffett and Charlie Munger. But I digress there. Okay, but there is a lack of downside protection with index funds. Investors who own an index fund, they can hedge against the returns of that index fund, but most people don't. Right, so they're very susceptible to the volatility of the market, and there's not a whole lot of downside protection, especially when, like I said a moment ago, a lot of the larger companies drive the index. And if the larger companies drive the index and we have a market meltdown, right, then a lot of the action is going to happen in those larger companies, and it's going to pull the indexes down hard and fast. Okay, then another thing we don't like about index funds is the lack of reactive ability. Index investing does not allow for advantageous behavior. If a stock becomes overvalued, it actually begins to carry a larger percentage of a portfolio, because as a stock gains in market cap, it will increase in a market cap weighted portfolio. If it increases in price, then it will increase in a price weighted portfolio, right? And so as a stock becomes more and more overvalued, it just takes up more and more of your portfolio. Whereas if you are investing on your own, as the stock becomes more and more overvalued, you are going to want to more and more trim your position of that particular stock. Okay, so you have to keep that in mind. You have to keep in mind that overvalued stocks are going to be very, very overvalued within an index fund. And it's far more likely that you see harsh pullbacks from those highs because you can't be reactive to what the market is giving you. Now, on the other hand, okay, when a lot of those larger companies become very undervalued, when the market drops quite a bit, you have more opportunity to buy and get a lot of value. But we're not talking about the things we like. We're talking about the things that we do not like. Okay, so lack of reactive ability. Also, you don't have control over your holdings. You don't have any control over what you're invested in. Okay, most people who buy index funds don't have a clue what they're invested in. Look, I can't sit here and tell you all of the companies that are held within an S&P 500 index fund that I own. I could give you a lot of them and a lot of the larger ones that are at the top that are driving returns on a large scale, but I can't tell you everything that I'm invested in there, and that's kind of an issue. I mean, it's not a huge issue because you know it's a market index, right? But you have money allocated into something that you don't really know what it is, right? Technically, you are a shareholder of all of those 500 companies if you own the S&P 500 index. And it's not likely that many people know all 500 companies that they are invested in. So that is another thing. It's nice to have control over your holdings. It's nice to have control over what you're invested in, because in having that control, you can be reactive, like I said a moment ago, and be able to make changes as needed, but you can still be invested in the things that are going to provide you the most upside over the long term. Now, another issue with index funds is they have limited exposure to different strategies. Okay, you don't have any strategy with an index fund. You are just invested in whatever fund it is. Right? There are countless strategies that investors have used with success. Unfortunately, buying an index of the market may not give you access to a lot of these good ideas and strategies. Investing strategies can at times be combined to provide investors with better risk-adjusted returns. Index investing will give you diversification, but that can also be achieved with as few as 30 stocks instead of 500 in something like the S&P 500 index. Okay, so if you are looking at companies in the market and you see that a lot of companies are overvalued, and there's a big argument that a lot of companies are overvalued as of now, right? Then that could really pull down on the indexes over time as fair valuations come back into play. But what could also be the case if you weren't in an index, right? You could allocate more money towards the value portion of the market, the value portion of a portfolio, and allow your money to hopefully grow in that value portion while the growth companies tend to struggle more in the short term, okay? Now, that is more of a short-term investing adjustment, but when you are investing in individual stocks and you've had a huge run-up in your growth stocks, taking some profits and taking a little bit off of a position in order to invest in other places is perfectly fine thing to do. But with index funds, you're stuck, right? You're stuck in a position where you can only invest in the index. You don't have any other strategies that are available to you. There's no tactical allocation. There's no growth and value balance going on. The growth is just dominating whatever's going on in the index at any given time. And then the pullbacks can be quite harsh because growth can tend to do that to a particular index. Then another thing that we do not like about index funds is dampen personal satisfaction. Now, what do we mean? Right? Investing can be worrying and stressful enough, right? Especially during times when the market is dropping by a lot. We're in some turmoil, right? But selecting certain stocks may leave you constantly checking quotes and can keep you awake at night. But these situations will not be averted by investing in an index. You still find yourself constantly checking. You still see the downside, right? The index is not going to keep you from seeing the downside in your account, right? But at least if you invest in individual stocks, right, you invest in individual things that you chose, then you will be able to see that, oh, I did this, right? I made this choice. I have the satisfaction of knowing why I made this choice, right? And even if it's going down in value, you can have conviction that the thing that you're investing in is still valuable and will still be valuable in the future, even after the turmoil in the market is over. Okay, so you can have that satisfaction, but you don't necessarily have that satisfaction with indexes because you just have to watch it fall until it finally reverses. Now, it will go up over time, okay, but again, these are the bad things about index funds, not the good things. Now, something that index funds do is they contribute to market melt ups and market melt downs. Okay, the popularity of index fund investing has increased the risk of irrational bull runs and sharp declines. Okay, on the upside, there are fewer active managers to sell at the top and keep runaway bull markets from getting irrational, but this sets up markets for eventual big sell-offs. Okay, there's another risk to the downside. With so much money in index funds, okay, active managers now have far less cash on hand to buy stocks during sharp declines, and this has blunted a natural shock absorber in the market. And so this makes the upside much further up because those active managers don't have as much money under management, and they're not doing as much selling when the market's going up. And then when the market is falling, when the market is at its lows, you don't have as many active managers coming in and buying at the lows. Okay, so you still have the same cash flows for the index investors, right? But those active investors, the cash flows just aren't there. The cash flows just aren't the same. So it contributes to the markets being up really high or down really low. And right now we are seeing an up very high. Now there are very many reasons for this right now, but the markets are, in most people's eyes, set for some type of pullback because they are so highly valued right now, especially relative to earnings and revenues and things of the like. Now, index funds, they also reduce the quality of stock analysis. Okay, Harvard Law School professor John Coates likes to say that index funds create social benefits in the form of lower expenses. And we've talked about that, right? The low cost is a very, very good thing. That's true, but it only captures a piece of the picture because when active managers underperform, as they charge higher fees than the index funds, they are still adding lots of value in our economic system. By deploying legions of brainy analysts to drill down on companies, active managers help ensure that stocks are priced correctly. But when you have the index out there, we don't really know if stocks are priced correctly all the time if there are a lot of inflows to index funds, because you'll see money just come into the entire index and the portfolio manager has to go out and just buy all the companies in the index, and that doesn't tell us much about the company being fairly priced. It just tells us that more people bought the index fund and will continue to drive the price up. Or if people are selling, it'll drive the price down, whether or not the companies within that index fund should be going up or going down at any given time. Of course, we know that active managers and their armies of analysts don't always get it right because active managers underperform so much. But without their work, securities are much more likely to be mispriced. That's because active managers are better at valuation analysis than the mom and pop investors in index funds. By definition, these passive investors have collectively thrown up their hands and said, I can't or I don't want to do any type of analysis, whereas those active managers are constantly doing analysis. Another thing about index funds is that they contribute to poor corporate governance. Index funds now own so much stock that shareholder voting power is getting concentrated in the hands of major players in the space, such as Vanguard, BlackRock, State Street, all of the really big index fund creators, right? It would be better to have more diversity among people casting shareholder votes on key issues, like who gets to be on boards or whether companies disclose political campaign contributions. Jack Bogle has been somebody who was outspoken on this particular issue, and he worried about this problem. He said in a Wall Street Journal opinion piece that if the popularity of index funds continues to grow, voting control over U.S. companies will be too concentrated. So that can be a big issue for these companies. You will have big institutions making all of the decisions, especially if people allow their votes to be proxied, which most index investors allow that to occur. So what's the bottom line here? What is the bottom line when it comes to index funds? The bottom line is you should put money in index funds. They're perfectly fine, right? We're not going to see the index fund go away anytime soon, okay? And especially if you're somebody who does not want to spend the time doing analysis. Like I said a moment ago, an index investor doesn't do much analysis, if any at all. Okay. If you're somebody who is not in the place to do analysis and you just want to set it and forget it type of investing, because we all need to be investing and we all don't have the time or the knowledge or the wherewithal to be in a place where we're doing constant analysis, right? If you just want to set it and forget it, put your money in index funds, that's perfectly fine, right? There's nothing wrong with that, right? And you cannot do that with other actively managed things. You cannot go and buy individual stocks if you don't know what you're invested in. Right, we talk about owning what you know when it comes to individual stocks. And so I don't expect you to go out and try to buy individual stocks for yourself if you do not understand those companies and you do not understand what those companies do to create returns for you, and you don't understand the markets as a whole and all these different types of things, right? And I've shown my disdain for active managers and the fact that they underperform so often, right? I've told you that there are some outstanding managers that do continue to outperform over time, but they are very, very rare and very, very hard to pick. And some of the biggest returns come to those individuals who are early into funds, not in funds once those active managers have already made some really great returns already, okay? It is not surprising that so many people want to flock to index funds because it is easy investing. It does give you returns of the things that you're seeing every day on TV in the form of the stock market indexes such as the Dow, the S&P, and the NASDAQ. It is no surprise that people are going to want exposure to those indexes because they've seen the returns that those indexes can provide over time, and they would rather have a guarantee that they make what those indexes do than have the question mark of the active managers or of trying to pick their own investments. And so I see very little downside overall. Even though I picked out a lot of things today, I was very, very nitpicky on index funds. I told you some things that are negatives or disadvantages about index funds. I am still extremely bullish on index funds. I think they are something that is going to continue to provide a lot of value, especially to the retail investor, especially to the least informed of the investment community, because everybody does need to be investing for themselves. We do not have pensions waiting for us like our grandparents did. We do not have as many corporate benefits sitting around as there has been historically, right? So we have to be able to save money for ourselves. We don't know if we're going to have enough Social Security. I'll tell you right now, you're not going to have enough Social Security to live the way you want to live. And who knows if we'll have any Social Security when it comes our time, right? So it is up to us to save money and invest for ourselves. And the index fund is going to allow us to do that in a very, very effective way over the long term. So I think that most individuals should be allocating a fair amount of money into index funds and then picking individual stocks if that is something that you have the patience and the mindset to be doing. And you can check out some of my other episodes on that. But don't get so down on the index fund because of what I've said today. Just understand these things, keep these things in mind, and they will definitely make you a better informed investor over the long term and allow you to make the best decisions for yourself when it comes to your investing future. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about taxes and index funds and how index funds may be able to help you to minimize your tax burden when it comes to your investing. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.